Short-term investments include savings accounts, money market funds, certificates of deposit, CDs, and short-term bonds. Interest rates may continue moving lower, making this a good time to look for relatively high yields. To decide where to put your cash, you need to consider your goals, time frame, attitude, and needs. Your Fidelity investment professional can work with you to develop a plan to help you invest your cash for the long term. Whether you are looking for a place to stash cash for short-term needs or waiting for the right opportunity to invest it for the long term, you have a variety of options. With the Federal Reserve expected to continue gradually lowering interest rates, yields on some of those options may be affected more than those on others. That makes this an excellent time to review how you manage your cash and make sure it's earning as much as it can. The good news is the range of options for keeping your cash safe and accessible while also earning interest are extensive. You can easily compare their yields and other characteristics on Fidelity.com, but finding the one that's right for you is not about just picking the highest yielding option. It also depends on your particular needs and time frame. That fact makes it useful to understand how cuts in interest rates might affect yields on the various options for storing your cash. Products such as longer-term CDs and bonds allow you to hang on to today's yields for a longer time, even as interest rates come down. To get those yields, however, you'd need to give up access to your cash in the short term, which may not be what you want. Here are 6 destinations to consider when determining where to put your cash. 1. Savings accounts. Savings accounts at banks offer flexibility and insurance from the Federal Deposit Insurance Corporation, FDIC. Some brokerage firms offer cash management accounts, which automatically move cash in their clients' accounts into bank savings accounts, which provide them with FDIC protection. Liquidity and flexibility. Savings accounts are liquid. That means you can access your savings when you need or want to. Insurance. FDIC insurance means the government would insure you against losing your money if the bank were to fail. The insurance covers losses of up to $250,000 per person, per bank, per account ownership category. That limit may require you to spread your money across accounts at several banks in order to make sure all your money is insured. Uses. Savings accounts can be good places to put cash that you need ready access to for bill paying or emergencies. Sensitivity to rate cuts. Savings account yields will likely dip following Fed rate cuts. 2. Money market mutual funds. Money market funds are mutual funds that invest in short-term debt securities with low credit risk and yields that tend to closely track changes in the direction of the Fed's target interest rate. There are 3 main categories of money market funds: government, prime, and municipal. Government money market funds 1. Hold Treasury and other securities issued by the U.S. government and government agencies. Prime retail 2 money market funds do too, but they may also invest in securities issued by corporations. Municipal retail money market funds invest in debt issued by states, cities, and public agencies. Liquidity and flexibility. Government and retail funds are priced and transact at a stable $1.00 price per share or net asset value, NAV. Insurance. Money market funds are not insured by the FDIC, and you could lose money investing in one. The Securities Investor Protection Corporation, SIPC, provides insurance for brokerage accounts that hold money market funds. SIPC protects against the loss of cash and securities, such as stocks and bonds, held by a customer at a financially troubled SIPC member firm. SIPC protection is limited to $500,000 and has a cash limit of $250,000. SIPC does not protect against declines in the value of your securities and is not the same as FDIC protection. Before investing, always read a money market fund's prospectus for policies specific to that fund. Uses. Money market funds can offer easy access to your cash and may make sense as places to put money you might need on short notice, or that you are holding to invest when opportunities arise. Sensitivity to rate cuts. Money market fund yields may come down gradually after Fed rate cuts. They can hold securities with maturities up to 60 days. That means the funds will still be able to pay yields from those longer maturity assets, certificates of deposit. CDs are time deposit accounts issued by banks in maturities from 1 month to 20 years. When you buy a CD, you agree to leave your money in the account for a specified period of time. In return, the bank pays you interest at a rate that is fixed at the beginning of that time period. CDs may offer higher yields than some other options for cash, but you may have to lock up your savings for a set period of time or pay a penalty for early withdrawal. You can buy a CD directly from a bank, or you could buy one through a brokerage firm, known as a brokered CD. If you buy a brokered CD at Fidelity as a new issue CD, there are no management fees or transaction costs if you hold it to maturity. Brokered CDs typically require minimum investments of $1,000. However, Fidelity offers fractional CDs with minimum investments of $100. Liquidity and flexibility. Because you can avoid those fees and transaction costs, it makes sense to hold CDs until maturity. If you own a CD in a brokerage account and need access to your savings before maturity, you will likely have to sell it for a loss and also pay transaction fees. Banks may charge fees for early withdrawals. One way to improve access to your money and avoid fees with CDs may be by building what is known as a ladder. A ladder arranges a number of CDs with staggered maturities. This frees up a portion of your investment at preset intervals as each CD matures and may help you to reinvest funds at higher rates as the rungs in your CD ladder mature. Insurance. CDs are eligible for FDIC insurance. A brokerage account can aggregate brokered CDs from different FDIC banks in one account, so you may be able to put more than $200